first question is, which of the following are the ways to mitigate the agency problem faced by a company? This is a previous year question that was asked in your November 2023 exam, which said that full transparency in all operations, giving a free hand to the agent and manager, linking CEO compensation directly to stock price performance, and it also said that regulation of principal agent relationship by contract, you were required to select the most appropriate option from the given. What would be the right answer? This is a 2 marks question that was asked. What would be the right answer? Now, if we talk about this particular question, so full transparency in all operation, that is that a way? Yes. Then can we give a free hand to the agent and manager? No. Then linking CEO compensation directly to the stock performance? Yes. And regulation of their contracts by their relation by the contracts, which is correct. So as per this, our answer should be first, third, and fourth. That's option number A. Now let me explain you what is this concept all about. If I talk about agency problem, what is agency problem? It is basically a conflict between your management and owners. That means members or shareholders. Correct? So this, the problem or the problem that is faced by the management and owners or the members, that is the conflict, is called as agency problem. Why? Because here the management act as the agent as they're appointed by the principals, correct, which are the members. Now the problem arises because member wants things or shareholder wants all the things of the company to be executed in a way where they are benefited. Now management is looking forward for everyone, right? They are looking forward for the shareholders, they are looking forward for other stakeholders like creditors, customers, government, then creditors, debt holders. They are looking for the benefit of everyone. They are working for the benefit of the company, but members would like to see all the benefits from their point of view. And due to this, the conflict arises. So in order to mitigate this conflict, or this conflict is called as agency problem. And in order to mitigate or reduce these conflicts, these are some options that could be tried. Okay. So moving to the next one, which of the following financial ratio helps in determining a company's capacity to pay dividend to equity shareholders? Return on capital employed, earning per share, debt to equity ratio, or interest coverage ratio? Which ratio would help in determining a company's capacity to pay dividend? What would be the right answer? Now, if we talk ahead about this concept, so there is one particular ratio that would help us is earning per share. Now, if I talk about earning per share is basically the earnings of equity shareholder, right? I would request you to answer the questions. Even if it is wrong, try to answer the question. A part of this earning is distributed, which we call as dividend. Correct. And a part of it is retained, which is called as retention for the growth of the company, future growth prospect of the company. So it is earning per share that would help in determining that what is the company's capacity to pay dividend to equity shareholder. These earnings actually are for equity shareholder. They are calculated as profit after tax minus preference dividend divided by number of equity shares. Then next one. A business earns a net profit before interest and tax of rupees 2 lakh and on a capital employed of 16 lakh. What is the return on investment? Now, return on investment is a profitability ratio, right? It is a profitability ratio or a profitability measure, correct? The formula is ROI is equal to just 1 minute. The formula is EBIT upon capital employed into 100. So we have a EBIT of 2 lakh. Our capital employed is 16 lakh into 100. So this would be 12.5%. That's option number C, right? The formula being EBIT. EBIT is your operating profit. Operating profit is basically the earnings that is available for all the stakeholders. We also call it as operating profit of a company. Because interest is a non-operating expense. So before interest and tax, both are non-operating. Then, from the following details, calculate the net profit of the firm. All the details that are given in the question, you are required to calculate the net profit of a firm. And I think we can do one more thing. We can also calculate net profit ratio. Net profit and net profit ratio. All these questions that we are doing today are previous year questions. Now, what is net profit? Let's calculate net profit. We have opening stock. We have closing stock. Then we have purchase, but we have purchase return. So our net purchase would be 13,816 minus 390. So net purchases is 13,426. Let's write it over here. Then import charges, that is our expense. All the expense will come in debit side. All the incomes would come on credit side. Then sales, but we have sales return. So net sales would be 15,248 minus 524. That would give us 14,724. Correct? Then we have closing stock that we have done and salary of 1,000. So let's do the total. 23,604. So let's do the total of both the side. Now let's see the difference. So 1958, that is the net profit. Correct? So net profit definitely is option number B. Now let's calculate net profit ratio. Net profit ratio is equal to net profit upon sales into 100. So net profit is 1958. Our net sales is 14,724 into 100. That means somewhere 13.30%. That is our net profit. So though in exam net profit ratio in this particular question was not asked, but never mind, we can always calculate it. Okay, let's move ahead to the next question. Which of the following best explains the concept of risk-return trade-off? Now, if we're talking about risk-return trade-off, what do you think is the right answer? Now, risk return trade-off is basically the relation between risk and return, also called as risk return trade-off, which means if a person is interested for higher return, they should be ready to bear the higher risk. Correct? That means higher risk should be rewarded by high return. Should be. But there's no guarantee for it. Right? So, to earn higher returns, an investor must be willing to accept a higher level of risk, but always guaranteed, you cannot assure it. Right? So, answer would be option number C. Also, how do we calculate it? Risk return trade-off. The formula: risk-free return plus risk premium. Then, a company has a credit sale of 1,20,000, debtors of 20,000, bills receivable of 10,000, and a debtors turnover ratio of 4 times. What is the average collection period? Again, a previous year question. You are required to calculate the debtors average collection period, like in how many days your debtors would pay you the amount back. Now, the formula for average collection period is, now see, this is in months. So 12 upon debtors turnover ratio. You don't have to do anything. So all that information is given. We don't need it. So 12 divided by 4 will give us 3 months. That's it. This was a 1-mark question. So easy. Now all this information, this is given for confusion, so that you end up calculating this ratio also. Right? So 30,000 divided by 1,20,000 is 4 times. Automatically you can solve it. You need not do that. Then, which of the following ratios are commonly used to measure the short-term solvency of a business? Debt equity ratio and capital gearing ratio, current ratio and liquidity ratio, return on capital employed and net profit ratio, operating ratio and proprietary ratio. What do you think would be the right answer? So we have 3 ratios: solvency, activity and profitability. Solvency is further divided into 2: long-term, short-term. Activity ratios are your efficiency ratios based on your sales, and profitability are profit-oriented business. Right now, they are asking you about short-term solvency, current ratio and quick ratio, also called as asset test ratio or liquid ratio. So that would be the right answer. Very good. Vanishtha, Kailash. Very nice, sir. And Ma. So in case you're planning to save these questions for future references, you can click on like button. Right now, next one. The debt equity ratio is primarily used to measure the short-term liquidity position of a company, ascertain the soundness of the company's long-term financial policies, assess the efficiency of asset utilization, determine the profitability of shareholders' equity. What would be the right answer? Very good. See, now you all are trying to answer. Excellent. See, now debt equity ratio is basically the measure of company's long-term position. It talks, see, solvency will talk about your ability to repay, right? What does solvency ratio talks about? They talk about the ability to repay. It could be long-term, it could be short-term. Long-term is debt equity ratio. Short-term is basically current ratio, that in a short-term, in a span of 1 year, will you be able to repay your debts or not? Correct? Short-term debts to your creditors, to bills payable. But again, when it comes for a long-term financial decision-making or financial soundness of the business, the ability to repay the debts on time, it is debt equity ratio. So here our answer would be option number B. Then, Section 135 of the Companies Act 2013 in India mandates that companies must donate a fixed amount to charity each year. Irrespective of their profits, they are required to spend at least 2% of their average net profit made during 3 previous financial years on corporate social responsibility. Should only focus on economic responsibilities, leaving social responsibilities to the non-government organization. Must integrate CSR activities as a voluntary action without any statutory requirement. What do you think is the right answer? What would be the right answer? Now, when we talk about section 135, this section is related with your corporate social responsibility. And corporate social responsibility says that a company is required to pay 2% of their average profit of last 3 years for social responsibilities, right? Like donations or helping senior citizens, setting up a different kind of charitable work for them, right? So these are all which are covered in your corporate social responsibility. And if particular, these years are previous years, right? Last 3 financial year. In any particular year, if the company has not earned sufficient profits, in that case, what we will do, we will exclude that particular year. So that is also very important to understand which has to be excluded. Correct? Any doubt? Then, next question. Again, a previous year question. A company has an annual credit sale of 10 lakh and an average accounts receivable of 1.6 lakh, assuming 365 days in a year. What is the average collection period? Now, the difference is, here they are asked in terms of days. So, 365 upon debtors turnover ratio, that is 10 lakh upon 1.6 lakh. .25. So 365 divided by 6.25, that will give us approximately 58 days. Correct? So this is 6.25 debtors turnover ratio and 58 days. Last question. Working capital management is concerned with the management of the current asset and liabilities of the firm. The major task in working capital management is the trade-off between profitability and liquidity. The profitability and liquidity are related to each other positively, inversely, neutral, or none of these. So we have done approximately 12 questions. Majority of them were previous year questions with a chance that they could be repeated. So definitely put an eye on them before you, when you're doing your final revision. So you can just click on the like button so that the session remains with you. Now, if you talk about liquidity, if some instrument has higher liquidity, what would happen? If liquidity is high, that means return would reduce, correct? And if return is less, that means risk is also less. So what would happen? It has an inverse relation between these two. High liquidity, less risk, less return. Okay. So these were the questions for today's class. Tomorrow I'll meet you at the same time and we'll be discussing 21 and 22. That is YTM and your annuity based chapter. Correct. Now one quick update. Right now, if you we are starting on 7th of April with MCQ batch, where for each subject we will be discussing approximately 750 questions each subject, totaling almost to 3000 question batch. If you are already enrolled in some batch and you want to upgrade to Mahapack or to question batch, correct? I am sharing a number only for the purpose of upgrade, because we are upgrading existing candidates at a price of rupees 2000 for Mahapack, and for question batch 1500. I would request you to go for Mahapack, because here you will find question batch for free of cost plus complete revision before exam. All this is paid, for which you have to call a particular number. I'm sharing the number, which is 8130243442. Immediately call on this number, because this is only available for 31st March. Here, for at a very minimum price, you can upgrade yourself for this amount. Correct? And in order to enroll for the 3000 MCQ batch, right, 3000 question batch, you can call on 098198192447, and you can use the code Y183 to get 83% discount. How can you enroll? You can visit Ada 24/7 website, or you can download our app. But do remember, the upgrade offer is only limited for today. You can upgrade your batch into Mahapack at a price of as low as 2000 rupees. It is limited up to 31st March. So please be quick, make your decisions so that it will not be available later. Right? So I would request you to enroll as soon as possible, and you can call on this number for the upgradation. For enrolling in a fresh batch, right, you can call on 098198192447. Again, the discount of 83% will also end tonight. So the agenda of today would be that we will be solving the questions related to chapter number 21 and 22. So 21 is exactly calculation of interest and annuity. It has very basic concepts, but the question coverage is seriously very low. Then we have financial mathematics, that is calculation of YTM, a chapter related to bond, but the coverage over here is good. Okay. So we will be discussing previous year questions and most expected questions of these topics. So the first question is, what is the inherent presumption taken while calculating simple interest? Select the most appropriate option from among the following. Right? This is a previous year question asked in the exam, that while we calculate simple interest, what are the assumptions that are taken? Interest is charged only once during the given period. Principal amount is always in the multiple of 1000. Interest is charged on daily basis. Time period is always in years. So whenever we talk about simple interest, it is assumed that interest is charged only once during the given period. The interest is not reinvested. The assumption of reinvestment is in compound interest. Then, under which type of repayment system is the entire amount repaid at the end of the loan period along with accumulated interest, or alternatively, the interest is paid periodically while the principal is paid at the end of the contract period. So it is amortized repayment, it is balloon repayment, it is equated monthly installments, or setup repayment. What do you think would be the right answer? So the right answer here would be, it says the entire loan amount is repaid at the loan end of the loan period, right? So it would be balloon repayment. Then a bond whose par value is 1,000 bears a coupon rate of 12% and has a maturity period of 3 years. The required rate of the return on the bond is 10%. What is the value of this bond? Now in exam, they can ask you intrinsic value or present value or fair value of a bond. How do we solve these questions? All these are the same synonyms for this. Now, whenever such question comes, first of all, how do we solve it? It says 3 years. Let's write over here 3 years. Okay. Now, the par value of a bond is 1,000 and the coupon rate is 12%. That means interest rate is 12% and interest rate will be cash flow that we will receive every year. So 12% on 1,000 will give us 120. Correct? So it would be 120 over here for 3 years. And at the end of the third year, which is your maturity period, you will also get the principal, which is 1,000, right? So you will not only get the interest, right? You will also get the principal amount. And all this is future value. Now, you are investing the amount today, correct? And this is the return that you will get in future. In order to measure it, whether it is worth or not, or what is the real value of our bond in terms of present value, we will have to convert our future value into present value. When we do so, we will use the formula future value divided by 1 plus R par N. Correct? This will give us present value. So there is trick also. That also I'll teach you. So now while we are doing the discounting, our rate of return, or our discount rate is basically what? Rate of return, which is 10%. So we will have to discount. My future value is 120 divided by 1.10. N is 1 year. Similarly, we'll move to the next one. 1.10 part 2. 120 divided by 1.10 part 3. And 1,000 divided by 1.10 part 3. Correct? Now, what would be the present value? 120 divided by 1.10. The value comes as 1049.73. That's option number B. How do we do so? See, check. I hope you are able to see the calculator. So, 120 divided by 1.10. First equals to, see, you will get the first value, which is 109.09, right? Along with that, press M plus. Then again equals to M plus. That's 99.17. Then third equals to, press M plus. That would be 90.16, right? Now, what is the principal value that will get? 1,000 divided by 1.10. Now, the life of this is, oh, so the N is 3 years. So, how many equals to I'll have to press? 3. 1, 2, 3. Plus again M plus. Whatever you want to add, press M plus. 751.13. And then for the total, press MRC. See, 1049.73 or 74. That's how you calculate the present value of bond. Correct? Now, a bond with a face value of 1,000 carries a coupon rate of 8% and is currently trading at 900 in the market. You are required to calculate the current yield of the bond. Again, a previous year question. Now, what is the formula of current yield? It is coupon amount divided by current market price into 100. So coupon amount will be 1,000, 8%. 1,000 into 8% will give you 80. The current market price of your bond is 900 into 100. 80 divided by 900 will give you 8.88%, or you can say it as 8.9%. Then, if a company has a pre-tax cost of debt of 10% and a corporate tax rate of 30%, what is the after-tax cost of debt? Okay. So, the rate of interest is how much, or the cost is how much? 10%. How much is the tax rate? 30. The formula will be interest 1 minus tax. So, my interest is 10%. 1 minus tax rate will be 0.70. That will effective rate of interest after tax would be 7%. So, it might seem 10%, but because we will be saving tax, our real rate of interest would be, instead of 10, it will be 7%. Okay, I hope this makes sense. Now, next one. The population of an industrial town is increasing by 5% every year. If the present population is 1 million, estimate the population 5 years hence and 3 years ago. What would be the right answer? You have to calculate the population 5 years hence and 3 years ago. Now, the population is 1 million, which is 10 lakh, correct? So, 10 lakh, it is increasing at a rate of 1.05% for 5 years, correct? So, in case when you have part, equals to would be press 1 less time. That means 4 times. Multiplied by 10 lakh. So this will come as 1276282. Though we have got the answer. Now if it is 3 years hence, we will have to find the present value. So 1.05 divided by 3. That will give us 863838. Division we will do equal time. So answer would be option number B. Then, which of the following is considered a negotiable money market instrument issued by a bank against funds deposited for a short-term maturity, usually up to 1 year, and is not classified as a long-term bond? So, which among the following is a negotiable money market instrument? Negotiable means which is transferable. It's not equity share, not corporate debenture. It is certificate of deposit. Sorry. Which is, yes, it is certificate of deposit. The minimum time is 7, maximum is 1 year. Then, what is the relationship between bond prices and yield to maturity? We have to tell about the relationship between bond price and YTM. Do they move in same direction? They're opposite of each other, or what? So this is a previous year question. The relation of bond and YTM is they are inversely related to each other, which means if YTM increases, the price of bond will decrease. Why? Because the expected rate of or interest market rate is increasing. People will start investing in other instruments, not in bonds. As a result, the demand of the bonds would decrease and hence the price would decrease. Whereby if the market interest rate or YTM has reduced, the bond price, the demand for bond would increase and the price would increase. That is why they are inversely related, also called as negatively related. Next one. If a saving account has 500 deposited at an interest rate of 4% compounded yearly, according to the rule of 72, how long will it take for the initial deposits to double to rupees 1000 with any additional deposit, without any additional deposit? So rule of 72 is basically used where it helps us to understand how much time will it take to double the amount that we have invested. So the rule of 72 simply says that divide 72 by R. Now, for example, if it is 4%, so it will be 18. It will take 18 years for us to double 500 rupees at a rate of 4%. Then the return on bond purchased by investor in the secondary market is equal to, see, the return that you are buying in secondary market, that would be equal to what? Yield to maturity, right? What is second? You will be selling it there. So that is the price you will be getting at maturity. So the return on bond that an investor will get if they are purchasing it in the secondary market would be YTM. The last question. Consider the following statement. Bondholders are the creditors of the company and not its owner. That's correct. Then interest on bond is payable only if the company earns profit. That's completely wrong. It is dividend which follows the same condition. Then interest on debt is tax deductible. Yes, because you're paying interest, it is an expense, you will have tax saving. Dividend on equity share is also tax deductible. That is wrong. Debt capital provides a tax shield to the firm. That is correct. Interest saving you are doing, tax saving you are doing on interest. So as per this, you have to say which of the following statements are correct. So you are not able to see one option. Just let me close this. So the right answer here will be 1, 3, 4 and 5. That would be our right answer. Correct. So option number D. Okay. Decision on capital structure of a firm is affected by banking requirements, cost of debt, taxation, all of the above. Now, before we answer this question, let's understand what is capital structure all about. What do we mean by the term capital structure? So capital structure is combination of capital and debt. Now when we say our structure capital is made up of two things. It is made of equity and preference. It is made up of debt. It is made up of two things. Now, when a person is deciding whether they want equity, whether they want preference shares, or whether they want debt, certain decision making have to be done with respect to what are the requirements, right? Which among them will be cheaper? Why? Because cost of debt, right? That is interest, gives us tax saving, but the dividend that we would pay to our equity will not result in tax saving. So then you would say that definitely, ma'am, cost of equity would be costly. So we should raise debt. But then you have to maintain a balance between debt equity ratio. So there are banking requirements also. We have to take care of debt equity ratio. We have to take care of that. Then if there is, the decline or the downward turn in economy. Sorry. Really sorry. So if there is a downward turn in economy, what would happen? We will have to pay interest, correct? But dividend we can skip. In the situation of loss, we have to pay interest. We don't have to pay dividend. So all these decision making have to be done, right? So that is why the answer is all of the above. While deciding on the capital structure from where we should raise money, we should think of all these conditions, that debt equity ratio limit has not over succeeded, right? Then cost of debt, we need to take care of that, because cost of debt gives us tax saving. It is a shield. It gives us tax shield. Then taxation we have to take care of. We have to take care of all these situations. What if the economy goes in recession? Then what would happen? What if the business is into loss? So all these conditions will have to be taken care of. Then moving to the next question. Which one of the following factors determine the forward points? Supply and demand for the currency for the settlement date, market views, that is expectation about the future, the interest rate differential between the countries whose currencies are being exchanged, all of the above. What would be the right answer? What would be the right answer? Now see, the various factors that are that would determine our forward points are, what are they? Now when we talk about forward points, we have spot rate. Spot rate plus forward points gives us forward rate, correct? So spot rate plus forward points will give us forward rate. Now what are these forward rates? These are basically our next rates. For example, if we are doing some transaction, we'll be executing it in future, then this is the rate that we'll have to follow. So these forward points will tell us whether our forward rate is at discount or they are at premium, right? So for this, what we have to do, or what it is dependent upon, it would be dependent upon supply and demand. Supply and demand is all about what is the demand of a particular currency, what is the supply in the market. Then what are the future expectations? What do we expect in future? Now see, LPG expectation in future is what? That there will be a shortage, due to which the prices increase. So future expectations also changes the price. Then the interest rate differential, the difference between the developed economy and underdeveloped economy or developing economy, is the rate of interest. So the rate of interest differential also creates or results in or influences or determines our forward point, right? So answer would be all of the above. If you remember, there is also the concept of interest rate differential. That tells us that how this is impacted. Then, if the risk-free return is 12% per annum and the expected return on the market portfolio is 16%, what will be the required rate of return on a company's equity which has a beta 1.50? Again, a very important question. It is based on CAPM. Now, what is CAPM? See, or what is this question related to? There is the concept of cost of the instrument, like for example, cost of debt, cost of equity. Now, if I talk about cost of debt would be interest 1 minus tax, whereby if I talk about cost of equity, there is not one method, there are 4 methods. One among them is CAPM, which is capital asset pricing model. The model says that the cost of equity will be the risk-free rate that is there in the market, correct? Then additional risk that we are taking, the return we should get if we are taking additional risk, into volatility. What is beta? Beta is volatility, volatile, correct? Now, as per this, what is the risk-free rate of interest that we have? It is 12%. Beta is 1.50. RM is given as 16% minus RF, which is 12%. So this will give us 12% plus 1.50 into 4. So this will give us 18%. 12% plus 6% That's 18%. So if I am raising equity, my cost of equity is 18%, represented by KE. Okay. Then, which one of the following approach is not used for calculating the cost of equity? Which among the following is not a method? What would be the right answer? Now, if I talk about which of the following approach is not used for calculating the cost of equity capital, there are 4 methods. Bond yield plus risk premium approach, yes. Dividend growth model, also called as Gordon's model. Then earning price ratio approach and CAPM, that we did right now. So which is not? Net income approach is not a part of it. This is a previous year question also on the same pattern, like which among the following is not an approach that is used for calculating the cost of equity. Then, which of the following is correct if in forward points the first figure is lower than the second figure? The base currency is at premium in forwards. The base currency is at discount in forward. No conclusion can be drawn based on this information. The base currency is at par in forward. अगर फॉरवर्ड पॉइंट्स जो है उनका पहला फिगर जो है वो कम है देन द सेकंड फिगर, then what are we going to assume, or what will that mean? What it would mean? Now, अगर प्राइस ऐसा है sorry 52.65, correct, that means the price is increasing. करेक्ट, तो वो किस पे होगा? प्रीमियम पे. ठीक है, सो इट विल बी द बेस करेंसी इज एट प्रीमियम, इट इज इंक्रीजिंग. So right answer will be option number A. Then, exchange rate today are determined by the present forces. Prior to the LERMs, the Reserve Bank fixed the buying and selling rates, and the market would remain within the ceiling and the floor, thus fixed by the Reserve Bank. What does LERM stand for? Liberalized exchange rate management system, then liberal exchange rate management system, liberalized exchange rate management standard, and none of the above. What would be the right answer? This is again a previous year question. What would be the right answer? LERM stand for Liberalized Exchange Rate Management System. That's option number A. Then, which one of the following provides a tax shield? टैक्स शील्ड इनमें से कौन प्रोवाइड करेगा? इंटरेस्ट ऑन बॉन्ड, इंटरेस्ट ऑन एफडी, इंटरेस्ट ऑन इंटर कॉर्पोरेट डिपॉजिट, या फिर ऑल ऑफ द अबव? देखो अब टैक्स, नाउ सी, tax shielding would, tax shield means saving of tax. Saving of tax is it will result when we have expenses, correct? So in case we have expenses, we will be able to save the taxes, correct? Now interest on bonds, interest on fixed deposit, interest on intercorporate deposit, which will result in tax saving? These two are your income, correct? Income will not save your tax, expense would, right? So income will increase your tax. Interest on bond is expense, right? So answer A. Then in London market, the US and euro rate is $1 is equal to 0.7 euro. In Mumbai, the dollar and rupee rate is $1 is equal to rupees 46.20. Calculate the euro rupee rate. What would be the right answer? $1 is equal to 0.7 euro, right? And in Mumbai, the rupee rate is $1 is equal to rupees 46.20. We are required to calculate 1 euro is equal to how many rupees? Now we can follow the concept of cross rate. Now here we have dollar. Whenever we have same currency, what are we supposed to do? Same currency. If left hand side we have same currency, this is your LHS, right? So if this has same currency, what we are going to do? We are going to divide the RHS. And what is in the numerator? We want rupees. So 46.20 divided by 0.70 will give us rupees 66. So right answer will be option number D. Correct? Now, next one. Which among the following represents the highest cost of capital? Equity, term loan, bonds, or preference shares? Which among the following would represent the highest cost of capital? Now, it is equity. Equity has the highest cost of capital. Why? Because there's more risk. There's no collateral, right? No collateral means if you're buying shares, will you get collateral? No. So no collateral means high risk, and high risk would say higher return. So if investor is expecting higher return, the company's cost of capital would increase. Right? Now, the last question. Match the item in column 1 with the item in column 2. Cash, ready, term, spot, forward. You have to match the column 1 with column 2. Match column 1 with column 2. Now, cash ready is, if it will happen on the same day, term is next working day. Then spot is after second working day, and forward will be after spot date. Correct. So A will be 2. B will be third. So our right answer would be option number C. Where we have to make or we have to take decision with respect to your um, fixed assets, right? Capital assets or capital investments. Then another part of unit 25 is term loan, and followed by that unit number 26, that is lease financing and equipment financing. We will be discussing MCQ questions, previous year questions, and most expected questions from this area. Let's start. The first question says, which of the following is not correct as per AS 19 on lease? As per AS 19, disclosure requirements applies equally to sale and leaseback transaction. AS 19 does not apply to lease agreements to use land. AS 19 prescribes appropriate accounting policies for both lessor and lessee. Lease can be classified as financial, operating, and reporting. You have to tell which of the following is not correct. I would also request you to share this session among your friends, your colleagues. 19 prescribe. What would be the right answer? Now, if we talk about AS 19, right? So AS 19 specifically talks about the lease, right? And there is also in the AS 116. But the question is as per your AS 19, so we'll restrict ourselves to the questions demand. Right, now, number one statement is that as per AS 19, disclosure requirements apply equally to sale and leaseback transaction. Yes, that is correct. AS 19 says that everything should be disclosed, whether you are into a sale and leaseback transaction, whether you're into financial lease or operating lease, everything should be disclosed in a proper manner. There is a requirement of disclosure which can be done into your notes to accounts. Then AS 19 does not apply to lease agreement to use land. That is also correct. The accounting standard 19 specifically clears this requirement that it will not apply to use land. Then it prescribes appropriate accounting policies for both lessor and lessee. Yes, there are separate accounting done in the books of lessor and in the books of lessee. But the lease can be classified as operating, financial, and reporting. That is wrong, because it is only classified as financial and operating as per Ind AS 16, 116, and also as per AS 19. The lease are classified as lease, financial lease, and operating lease. The right answer here would be option number D. Why? Because the statement is wrong. It also covers the term reporting lease, which is incorrect. Right? Then moving further to the next question, which of the following is not a source for meeting the cost of purchase of fixed asset by an enterprise? Credit by suppliers of asset, internal accruals, debentures, or DPG. Now, which of the following is not a source of fund for meeting the cost of purchase of fixed asset by an enterprise? What would be the right answer? Like if you want to buy a fixed asset, which of the following is not a source of fund for meeting the cost of purchase of fixed asset? Now, number one. So we have to tell that which among the following is not. Now, credit by supplier of asset, internal accruals, debentures, or DPG. Now, deferred payment guarantee is not one of the source. Now, what is deferred payment guarantee? What is deferred payment guarantee? Let me explain you. So, deferred payment guarantee is a guarantee, right, that is provided by the bank to the supplier. Now, there are two people. Let's say it is A, who's the buyer. We have B, who's the seller. Correct? Now, the buyer wants to buy the goods from seller, and that is a fixed asset on credit basis. Correct? Now, why deferred payment guarantee is not a source of fund? Because it is a non-fund based. It is non-fund based, right? All these are fund based. It is non-fund based. Now, The buyer is looking forward for purchasing the asset on credit and B is not ready to provide the fixed asset on credit. So what does the A do? A reports to bank, right, and is looking forward for some support. The bank approaches seller and says that, hey seller, if Mr. A defaults in the repayment of the EMIs, installments of the fixed asset, then I am giving you a guarantee that I would repay the amount on his behalf. That guarantee the bank is taking on equated installment basis is called as deferred payment guarantee. That bank would be there to support Mr. A's non-payment to Mr. B, who's the seller, right? So it's because it is a non-fund based source, that is why it cannot be a source of fund for meeting the cost of purchase. Then, a lessee can be defined as a person who takes a property on lease, sells a property, buys a property, or gives a property on lease. What would be the right answer? See, what is basically lease? Lease is basically a mechanism which helps you to act like as a owner of an asset without actually owning it, right? So what happens in a lease is there is a owner to whom we refer as lessor, and this lessor or the owner is owner of what? The person is the owner of the asset or the equipment, correct? This owner, this lessor, is the owner of the asset, right? And tenant can be referred as to lessee, is the one who is in need of using this asset, right? So lessee is the one who is in need of using the asset and lessor is the one who owns the asset, right? He is the owner of asset. This asset that we are referring in our case is basically called as leased asset. We call it as leased asset, right? Now, the lessor would provide this asset on lease to the lessee. Now, because lessee is using the asset of the owner, he would have to pay a cost of it, the cost of using the asset, which is called as lease rental. This is basically the cost of using asset. Correct? So the cost of using asset is basically the rental that lessee would pay to lessor. So now who is a lessee? A lessee is a person who takes a property on lease, that is option number A, right? Lease is covered under AS 19 and Ind AS 160. Okay, moving further. What is the average rate of return if initial investment is 8 lakh and the project life is 3 years, during which the average net profit is estimated at 28,000 per year, the scrap value is estimated to be 0, you are required to select the most appropriate option. It is a previous year question. What is the accounting rate of return? Now, meanwhile you solve the question, let me summarize capital budgeting for you or capital investment decision. Now, when we talk about capital budgeting or capital investment decision, it is a process of taking a decision with respect to buying an asset or not, investing in a project or not. Why? Because this comes at a huge cost. Resources are limited for all of us. The company is also facing the challenge of limited resources and has to take a right decision, a decision that would maximize their profit, correct? And in order to take that right decision, there has to be some technique that has to be followed. So while making a decision in capital budgeting, there are two types of technique. One could be referred as traditional techniques or non-discounted techniques, and other the modern techniques or discounted techniques. So there are two types of techniques, traditional and modern. Now, when I talk about the traditional techniques, correct, they have two methods, which is payback and ARR. That is accounting rate of return or average rate of return, whereby modern has multiple methods, but again, in your syllabus, you have only two, that is NPV and IRR technique. Correct? Now, all these methods are based on cash flow except one, and that exception is ARR. Only ARR is a profit-centric method. ARR is basically your profit-centric method where the evaluation of project is not done on the basis of the real actual cash flow that it will generate, but on the basis of profit. The problem is that this profit also includes non-cash expenses which have actually not impacted your cash. So that is also a disadvantage, that it is a profit-centric method. All other methods, whether you say payback, NPV or IRR, it is a cash flow-based method or cash flow-centric. Now, coming on to ARR, and let's decide how this technique is used for the purpose of decision making. Now, the formula of ARR is average profits divided by average investments into 100. Now, it says that the accounting rate of return if initial investment is 8 lakh and the project life is 3 years, during which the average net profit is estimated as 28,000 per year. So definitely the examiner has simplified this question by directly giving us the average profit, which is 28,000, but average investments have yet to be calculated. Now the average investment would be 8 lakh minus 0 divided by 2, because they say that the salvage value is 0. So that would be 4 lakh. So 28 divided by 4 lakh into 100. So can we do the maths? This will come around 7%. So the right answer will be option number A, that is 7%. Now when we talk about ARR, do remember there is one more concept of mutually exclusive case. Right, we have one more concept of mutually exclusive events, which says that the project with maximum ARR will be selected. Like if it is now, if there are two projects A and B, one has 7% of ARR, other has 8% of ARR, and I am supposed to do a decision making on the basis of ARR, that I will choose a product which has maximum ARR, right? Because it is in terms of profit. Okay. Then moving further to the next question. In a lease transaction, which of the following is required to be shown on the asset side of the balance sheet of the lessee? The total purchase cost of the asset, total of all the lease rental payments, right of use of asset, or lease liability. In a lease transaction, which of the following is required to be shown on the asset side of the balance sheet of the lessee? Now, if we talk with respect to lease transaction, what would be shown? See, they are asking on the balance sheet of the lessee. As lessee is basically using the asset and he's paying a cost for using the asset. So basically it would be right of use asset. Then, which of the following statement is not true for an infrastructure project? It has long gestation period. It reduces the risk for lender as his funds get assured deployed for a deployment for a long time. Normally, the debt equity ratio is high for an infrastructure project. The implementation period is usually long. We are supposed to tell which of the following statement is correct. In case you like the session, do not forget to click on the like button. So which of the following statement is not true? Number one, it has long gestation period. Correct. The debt equity ratio is high. Yes. The implementation period is long. It reduces the risk for lender as his funds get assured deployed. But that's not the concept of risk, right? So the answer here would be option number B. This is not correct. Then, which of the following types of lease involves the operation, insurance, and maintenance function to be performed by the lessee? Select the most appropriate option. Domestic lease, dry lease, wet leased, or leverage leased. So we are talking with respect to lessee, right? So when all the involvements where the operation, insurance, maintenance and functions are performed by lessee, this is a type of financial lease. Correct. It is a type of financial lease. And in case of financial lease, I'm looking forward for answer. Who is responsible? What it is called as? Wait, sorry, dry lease. Right. So in case when the lessee is taking all the responsibility, right, we call it as dry lease. And in case of wet lease, all the responsibilities are performed by your lessor. Then, which of the following statement regarding the payback period method are correct? Does not consider the time value of money? Yes. Our payback period method will not consider the time value of money. It is a non-discounted technique. Then, it may lead to investment in riskier projects. Yes. How? I'll explain you. See, in payback period method, you're only focusing on the payback, like the time the project would return the amount. After that, what would happen does not matter. That is why initial areas of recovery are taken care of and the later part, which could be risky for us, are ignored. Minimum payback period should be 5 years. There's no such minimum requirement, so that is completely wrong. In the payback period method, cash flows till the end of the asset are required to be considered. No, the cash flows are only needed till you are able to recover the cost of asset. See, payback method specifically focuses on paying back, right? How much time it would take to recover the cost of asset. So that is why this is wrong. And the right answer will be option number B. That is 1 and 2 are only correct, else other statements are wrong. Now, payback period method is a cash flow centric method. Right? It is a cash flow centric method. That means we will be focusing on cash flow. Analysis will be done on the basis of cash flow. And if there are two projects, right? If there are two projects, we will select the project with lowest payback. Why? Because it is measured in terms of time. So the project with lowest payback period, I'm so sorry. The one with the lowest payback period would be selected. Okay. I hope this part is clear. Now, which one of the following is a distinctive feature of a wet lease? The lease asset is operated by the lessor. The leased asset is transferred to the lessee at the end of the lease period. The lease is for a long period. The lease can be terminated at any time. Now, the important part is, which one is a wet lease? It is operating lease. Now, we have to think about operating lease. What happens in operating lease? This is wrong. It is not for a long period. That is wrong. It is not end of the period. It is not transferred. The leased asset is operated by the lessor, and another statement says that the lease can be terminated at any point of time. Now, these are the two statements which are decision making and we'll have to decide. Correct? See, lease can be terminated at any time. That that is a little unfair. Definitely it comes with repercussion. So that is not a distinctive feature, right? But the distinctive feature is it is operated by the lessor. That is a unique feature of it. The lease are, if they are cancelable lease, they can be cancelled or they can be terminated. But the important and a distinctive feature is that in case of operating lease, the leased asset is operated by the lessor, whereby in financial lease, it is operated by the lessee. Okay. So these were the important questions from our 2 units. The first question says a company has issued commercial paper on 1st of January and wants to buy it back on 20th January. What should bank advise? Bank should allow buyback as per the market advice, allow only through primary market, reject as minimum holding period is not completed, allow if both the parties agree. What do you think would be the right answer? Now, if we talk about commercial paper, right? So if we're talking about commercial paper, what are commercial papers? Commercial papers are the debt instruments, correct? So commercial papers are basically kind of a debt instrument which helps the organization to raise debt, correct? They help organization to raise debt. Now, in case of commercial paper, the buyback is possible, but the essential condition is the company should have 30 days of holding period. So we will need 30 days of holding period, which means the company has to have the commercial paper with them for 30 days, and only then they can think of buyback. So because the duration is less than 30 days, it was issued on 1st January and 20th January, they are asking for buyback, then this condition is completely wrong. We should reject, as the minimum holding period of 30 days is not yet completed. We cannot approve it. Correct? Commercial paper, for the purpose of issue of commercial paper, the minimum value is 5 lakh, right? It should be in the multiples of 5 lakh. Minimum time is 7 days and maximum is 1 year. Okay. Next one. Question number 2. Interest rate options are disclosed as an off-balance sheet item, a liability in the balance sheet, a separate expenditure item in the P&L account, or as asset in the balance sheet. What do you think is the right answer? Interest rate option contract are disclosed as. So if we talk about interest rate option contracts, they are disclosed as, or see, they will be disclosed as an off balance sheet item, right? They're not the balance sheet based item. Derivatives are reported under off balance sheet item. Interest rate option contracts are such contracts where your uh, appearance or disclosure would be done in off balance sheet. Then, a company imports non-capital goods and requests trade credit for 18 months, stating that its operating cycle is 20 months. What should the bank do? Allow 18 months as operating cycle is higher, allow 20 months based on operating cycle, restrict to 12 months, reject the proposal completely. What do you think would be the right answer? Now see, if we talk about trade credit to importers, so trade credit for imports of goods and services and raw material is provided. Only exception is gold. Gold is not covered in this category, right? So exception is gold. Then for the purpose of capital goods, the duration is 5 years. The credit could be provided for 5 years, and for non-capital goods, it is 12 months or 1 year. This cannot be extended. The rules clearly says that this cannot be extended. This cannot be enhanced. So as per this, the right answer would be that you will have to restrict it to 12 months. Non-capital goods means raw material. If you want to import raw material, in that situation, the credit could be provided, but to the importer, but it will have a maximum duration of 12 months. If it is a capital goods, like you're buying fixed assets, for example, machine or any equipment, then it could go up to 5 years. Otherwise, it would remain it up to 12 months. Then, a company plans to issue commercial paper of 1200 crore during a financial year. The commercial paper has a maturity of 9 months and is proposed to be issued in physical form at face value. The company has obtained one credit rating of A3. It also proposes underwriting support from bank and plans to buy back after 20 days. Which of the following statement is correct? The issue is valid as all regulatory conditions are satisfied. The issue is invalid only because buyback is before 30 days. The issue is invalid due to multiple regulatory violation. The issue is valid if the bank provides guarantee. What do you think would be the right answer? Now, if we talk about the commercial paper that we are seeing here, see, commercial paper comes up with many regulatory guidelines. And the first guideline being is that when a commercial paper is issued, all the loans have to be standard. It can be issued by those corporates whose net worth is 100 crore or more. Now, when I see the first line, which says a commercial plan to issue, a company plans to issue commercial paper of 1200 crore. I remember this condition which says that if the issue size is more than 1000 crore, then the organization has to get credit rating done from 2 agencies, right? So it says that the company has obtained one credit rating agency, that is from rating from one agency. That is wrong. We will have to get our rating done from 2 credit rating agencies whenever the amount of issue is more than 1000 crore. Right, so this condition is wrong. They are issued in DMAT form and not physical form, so that is also wrong. Then it says that it is proposing underwriting, which is not allowed in case of commercial paper, so that is also wrong. And then buyback is done in 20 days, which is also again wrong. That is 30 days. So there are multiple regulatory violation, and hence this issue is not right, because there are so many violations of the rules and regulations. Then a micro enterprise has an estimated annual turnover of 2 crore. Its working capital cycle is 6 months. As per RBI turnover method, the bank assesses working capital at 20% of turnover. However, based on holding level method, the actual requirement comes to 80 lakh. What should the bank do? Sanction 40 lakh as per turnover method, sanction 50 lakh including margin requirement, sanction 80 lakh as per holding level method, reject the loan as turnover method is not applicable. What do you think would be the right answer? What would be the right answer? Now see, an enterprise has an annual turnover of 2 crore, correct? Working capital cycle is 6 months. So as per RBI turnover method, the bank assesses working capital at 20% turnover, correct? So if it is 20% turnover, which is correct. However, based on holding level method, the actual requirement comes to 80 lakh. Now see, if I calculate 2 crore 20%, so how much it would be? That would come to 40 lakh, correct? But the actual requirement, if we follow holding level method, it is coming to 80 lakh. Then what should be done in that situation? So see, definitely whenever we think of turnover method, here the consideration is taken as 25%, which is considering that an organization has its working capital cycle of 3 months, right? If the credit cycle or operating cycle is more than 3 months, then this method would always underestimate the value of your working capital. Like in this case, the working capital cycle is 6 months. That is why this is going wrong. right? So in this situation, the working instead of following the annual turnover method, the organization or the bank should finance it as per 80 lakh or holding level method, because here the working capital cycle is more. Understood? So operating cycle in your annual turnover method is presumed to be of 3 months, because it is 25%. No? So 25% means 1/4. That means 4 divided by 12, 3 months ka cycle. So 3 month cycle, they assume it, and as per that, they have told it as 25%. But here, because the working capital is of 6 months, this limit would always come less. Then, which of the following statements are correct in relation to credit default swap? Market makers shall ensure that all CDS transactions by retail user are undertaken for the purpose of hedging. Retail users shall exit their CDS position within 1 month from the date they cease to have underlying exposure. Market participants shall settle CDS contracts bilaterally or through any clearing and settlement arrangement approved by the Reserve Bank. CDS contracts are mandatorily required to be cash settled. Which of the following statement is not correct? Now, number one, first one, market makers shall ensure that all the CDS transaction by retail users are taken for the purpose of hedging, which is correct. Whenever we talk about credit default swap, what is credit default swap? It is basically bank has provided loan to, let's say, a party, and now the bank is doubtful about it. What can bank do in order to protect their risk from being eroded over here, being lost by converting it into NPA? They can approach a CDS buyer or seller. A CDS seller would sell credit default swap to bank. In turn, the bank would buy that and will pay premium for this purpose. Now, the benefit of CDS would be that on the due date, if Mr. A does not turn up with the amount of loan or does not repays it, then in that situation, the loss will be borne by CDS seller. That amount would be paid by him to the bank, and bank will not be at loss, because bank was paying a premium to cover the loss, to cover the risk. So here, if you see, bank was trying to protect itself from the risk. Now, when you are trying to protect yourself from risk, that is basically your hedging. Correct? Then retail users will have to exit the position within 1 month from the date they cease to have underlying exposure. That is correct. So within 1 month, they will have to exit their position. They cannot extend it beyond that. Then market participants shall settle CDS contract bilaterally or through any clearing mechanism approved by Reserve Bank of India. That is also correct. Then CDS are mandatorily required to be cash settled. Now this is a problem over here. CDS can be settled in pack form. What is pack? Physical, auction and cash, but not cash. Right? And if it is a retail user, it can be settled via your auction, right? Or cash or physical form. So you have to tell me this. Yeah, we can do that. So if it is a retail user, how can a retail user settle it? How will a retail user settle it? You have to answer that in comments. Now, as per this statement is wrong. First, second and third is correct. So our answer would be option number D, that is first, second and third. Then a company with a working capital limit of 7 crore approaches the bank for renewal of limits. The company operates in a seasonal business and submits a projected cash budget statement showing a peak cash deficit of 3 crore. The company has strong MIS system, qualified finance team, computerized reporting system, chargeable asset available. The bank is considering switching to cash budget method. What should be the most important decision by the banker? Continue with the turnover method as it is mandatory for all borrowers. Then sanction 3 crore as a working capital limit based on peak deficit. Sanction 2.25 crore after deducting margin of 5%. Reject cash budgeting as it is not applicable in India. What do you think is the right answer? Now, here, if we talk about the cash budget method, right, this method works on the basis of peak deficit, right? So this method works on the concept of peak deficit. Now, what is peak deficit? Peak deficit means the time where, or the month where, the organization has incurred highest, more of outflow and less of inflow, right? So that would result in deficiency. So we call it as peak deficit. Now, out of this peak deficit amount, 25% has to be the margin money, right? It will be the margin money, and 75% will be bank finance. Correct? So let's see according to this. The most appropriate decision by the banker, continue with turnover method as it is mandatory for all borrowers. Sanction 3 crore as working capital limit based on peak deficit. Sanction 2.25 crore. Now, how much is the peak deficit? It is 3 crore. So 25% of 3 crore would be 0.75. So 0.75 will be our margin money, whereby 2.25 crore will be financed by the bank. Right? So the right answer will be option number C. Then, with reference to rupee denominated trade credit for imports, consider the following statements. Trade credit can be raised for import of all items including gold. Trade credit for non-capital good is up to 1 year or operating cycle, whichever is higher. Trade credit for capital goods can be up to 5 years from the date of shipment. Authorized dealer category 1 bank cannot permit any rollover beyond permissible limit. Which of the above statements are correct? So trade credit can be raised for importing of all items including gold. That is wrong. We have done that today, that gold is not a part of it. Then trade credit period for non-capital goods is up to 1 year, yes, and or operating cycle, whichever is higher. Then trade credit period for capital goods can be up to 5 years, that is correct, and authorized cannot permit, this is also correct. So higher is not allowed, this limit is there, so it would be, the right answer will be third and fourth. These two statements are correct. Then the last question, which of the following is not a feature of interest rate swap? An interest rate swap is a series of FRAs. Then the notional principal is exchange between the counterparties. Buying an IFRS means choosing to pay fixed and receiving floating. Price of an IRS are quoted in terms of fixed length. So we are supposed to find out the right answer. Now, interest rate swap is a series of FRA, and the notional principal is exchange. So see, definitely interest rate swap is part of forward rate agreement where you're deciding the forward rate. The notional principal is exchange. That's wrong. This is right and this is right. So our answer would be option number B. This is incorrect. Okay. And I'm sorry, this is the last question. A company plans to issue a commercial paper of 1200 crore in a financial year. Which of the following is correct? 1, credit rating is sufficient. Minimum rating should be A2. 2 ratings required, and lower rating will be considered. Highest rating will be considered. Now, because the issue size is 1200 crore, we would need ratings from 2 credit rating organization, and the lower one would be considered, right?
If the tax collector, who is responsible for collecting the TCS, does not collect the tax, or collecting doesn't pay it to the government before or on the due dates, so he is liable to pay interest of dash per month. Now you have 4 options: 5%, 4%, 2%, 1%. Yes. Now first we need to understand what is the meaning of TCS. So everyone just see on your screen. TCS means tax collected at source. Okay. Generally, TCS is applicable between seller and buyer relationship. Here, seller supplies some specific goods. Yes, let's say tendu leaves. Tendu leaves is one special or specific goods which is actually applicable for TCS. Now, as soon as buyer supplies tendu leaves goods, buyer is required to pay payment. Yes. So here, let's say buyer is paying price of the tendu leaves. Let's say that is 20,000. Plus, along with this price, here buyer needs to pay tax amount. Let's say 5,000 rupees. So total amount buyer is going to pay, that is 25,000. So here seller will keep this price of 20,000. Yes, and this remaining 5,000 seller will transfer to the government. Seller will collect total amount 25,000, but this 5,000 belongs to whom? This 5,000 belongs to government. Yes. So here seller will transfer this TCS to the government. Yes. Here this tax is known as tax collected at sources. Remember, on some specific goods only we charge TCS. Like you are paying income tax return, like in your ITR, you have some due dates like 31st July is for individuals. Yes or no? Similarly, here seller is also required to submit this TCS return to the government on quarterly basis. On which basis? On quarterly basis. Yes, but sometimes if seller is not paying on this quarterly basis, then seller is liable to give interest. Yes, as a penalty, seller needs to submit here one penalty. And in this question, they're asking about what is the penalty amount that seller needs to pay to the government if he is not submitting quarterly reports, or if he is actually collected any amount from the buyer and he doesn't deposit to the government. That amount is 1% per month. Yes, right answer is 1% per month. So all your first three options are wrong. I hope you got this. What is the meaning of TCS? How this TCS is applicable, and what is the interest, or you can say penalty amount, that seller needs to pay to the government if he is not paying on quarterly basis. Chaliye, coming to next question. The TCS collector must provide TCS certificate to buyer. Now this certificate is issued in the form. Okay. Again, this question is based on your TCS. Okay. Under TCS, you have one seller, you have buyer. Okay. Seller will supply goods to the buyer. Yes. Seller will supply here goods to the buyer. Let's say again, tendu leaves are supplied by seller to the buyer. Okay. And in return, buyer will make the payment. Okay. And payment value is again same. Price equal to 20,000 plus TCS amount. Now I think everyone knows what is TCS amount. Total 25,000 is paid to the seller. Now what seller will be doing? Seller will keep 20,000, yes, as a cost of or price of this tendu leaves, and remaining amount, that is 5,000, will be paid to the government. Yes. Now while submitting this 5,000 to the government, here one TCS return seller needs to submit. On which basis? On quarterly basis. Okay, on quarterly basis. So here seller requires some form. Achha, can you tell me which form is used here when seller is submitting TCS return to the government? Yes, so this is your homework question, everyone. You need to tell me which form is used by seller for submitting TCS return to the government. Okay, this is the one scenario. Now on the other hand, buyer says, oh, this amount belongs to me. I am paying this amount, so I want some proof that this 5,000 is actually, which is collected by the seller, is actually deposited to the government. So what's the proof? So here seller needs to provide TCS certificate. Yes, which certificate? TCS certificate to the buyer. And this question is asking under which form TCS certificate is provided to the buyer. Yes, TCS collector must provide, means seller must provide TCS certificate to buyer. Now this certificate is issued in form which, that is 27D. Okay, 27D is your right answer. चलिए, again this question is based on your TCS. I hope this point is clear, and in this particular question you have one homework question as well, that which form is used by the seller to submit a TCS return to the government. Okay, chaliye. Now coming to next question. Again very easy question. Which among the following income are not included in computation of total income of any person as per Income Tax Act? Now this question is very rare question. If you remember section 10 of your Income Tax Act, yes, in your classes we have actually covered one list, and I told you you need to remember that list. So as per all these options you need to identify, though you can say all these are income, but you will never charge income tax on it. You will never charge tax on it. Yes, so agricultural income, you will never charge in tax on it. So this is true. Gratuity amount, this is true. Amount received under travel concession, oh, we need to hold this. Scholarship granted to meet the cost of education, this is true. Some received on voluntary retirement, true. Payment from an approved superannuation fund, this is true. So except your third point, all of the options are correct. Yes, so here only 1, 2, 3, 4, 5. No. Some received on VRS is also exempted. Payment from this approved superannuation fund is also exempted. Only 1, 2, 3. No, this is wrong because they're including 3. Okay. So all of the options are not correct. Here you need to eliminate this third point. Otherwise 1, 2, 3, 4, 5. And you need to add here 6. So right answer is answer A. Okay. Chaliye. Now coming to next question. Okay, everyone. Which among the following, yes, please read it together. Let's read it together. Which among the following statement are true with respect to income tax? It is based on the ability to pay principal. Those who earn higher income have to pay more taxes. It is based on the ability to pay taxes, which is a way to redistribute the wealth of nation. Income tax is a direct tax and regressive in nature. Fifth, taxes keeps a track of financial transactions and tax payment status of person and entities. Yes. Now you need to identify which option is correct here. Okay. So it is based on the ability to pay principal. This is true statement. Okay. Then those who earn higher income have to pay more taxes. This is also correct. Third, it is based on the ability to pay taxes is a way to redistribute the wealth of the nation. Is it so? Are you redistributing any wealth of the nation? No. Hana, this is no. Then income tax is a direct tax and regressive in nature. Is this regressive in nature? No, this is progressive in nature. So this is also false. Okay. Then taxes keeps a track of financial transactions and tax payment status of person and entities. So taxes keeps a track record of financial transactions and tax payment status of person and entities. This is true. So correct options are 1, 2 and 5. 1, 2 and 5. Okay, I don't know. Okay, so here this is a mistake. Right answer is answer C. 1, 2 and 5. Yes, only these 3 options are correct. Okay, chaliye next. A registered dealer in Gujarat sells goods to another registered dealer in Gujarat. Now identify the correct tax treatment. Okay, now this question is based on GST. Yes, this question is based on now GST. Now under GST, you have 4 types of taxes. Yes, you have CGST, SGST, UGST, IGST. These are the 4 types of taxes that are covered under GST. Okay. Now, when you are transferring, a point is same state transaction. If same state transaction is there, suppose from similar state like Madhya Pradesh, goods are supplied to Madhya Pradesh only. Okay, seller is also from Madhya Pradesh, buyer is also from Madhya Pradesh. Then you are going to charge GST under CGST plus SGST. Okay, this is one point. Second point is, in case of interstate, yes, or when you cross state boundary. Yes, suppose this is your one state known as Madhya Pradesh. Now you are supplying goods to, let's say, Gujarat. Here you are transferring from one state cross, you're crossing one state boundary, so you are going to charge GST equal to IGST. Okay. Now third condition is, if same state plus UT, Union Territory. For example, you are transferring from Ladakh. Okay, you are also from Ladakh, seller, and buyer is also from Ladakh. In this case, you are going to charge GST equal to CGST plus UGST. Okay, so these are the three conditions, like how you can charge all these different types of taxes under GST. Now, please read this question. A registered dealer in Gujarat sells goods to another registered dealer in Gujarat. Identify the correct tax treatment. IGST, CGST plus SGST, CGST only, or no tax. Now, seller is also from Gujarat, okay, and buyer is also from Gujarat. This is your same state condition, है condition A. So what type of GST you are going to collect here? CGST plus SGST. Yes, so right answer is answer B. Chaliye, I hope everyone got this. Next, who is liable to pay GST in case of e-commerce transactions? Notified services like cab services, seller, buyer, e-commerce operator, or government. Remember, when we are talking about e-commerce under GST, so they are paying TCS. In your GST, generally, suppliers are required to submit GST to the government. Okay. In case of TDS under GST, you are going to pay amount to the government, but here in your TDS, government is your buyer here. So government deducts some amount of TDS under GST and then they are paying to you. Okay. Especially when you are entering into government department transactions, then TDS under GST is applicable. TCS under GST is applicable when you are doing e-commerce activities like Myntra, Flipkart, Zomato, all these things. Okay. All these companies are known as e-commerce. And here, if you are actually e-commerce company, you are doing all the working through online business, then you need to collect TCS here. So, who is liable to pay GST in case of e-commerce? Your answer is going to be answer C. It is applicable only in case of e-commerce. If government department is given in your question, then you need to say TDS under GST. Okay, chaliye. So these are the few points, like who is liable to pay GST amount. Next, which of the following statement is correct? Normally, supplier pays GST. Okay. Second, under RCM, recipient pays GST. Third, GST is always paid by the government. A, only one statement. Only second, B option 1 and 2. C option 2 and 3. D all. You need to identify correct statement here. Okay. Now let's talk about one by one conditions given under this. Normally suppliers are required to pay GST. Hanal, this is your supplier. Here you are standing. Yes, you will pay amount of cash plus GST to the supplier. Then supplier will pay to the government. This is general scenario. This is your normal scenario. This is your normal scenario. So first point is, normally supplier pays GST. This is true. Okay. Now coming to next statement, under RCM, recipient pays GST. Okay. So now let's discuss this second point. Here is a supplier. Here you are standing. Okay. Let's say this supplier is from outside India. Okay. Let's say this supplier is from USA and you are importing goods from USA. Yes, now you need to make the payment. As you are purchasing goods or services, you need to also include GST under this. But as this supplier is outside India, so government cannot collect any amount from supplier who is residing outside India. So what government will do here? Government will collect GST amount from recipient. So in some situations, like in import situation or in some specified categories, if recipient is liable for the payment, then this is known as RCM. Only in some situations, है ना? So under RCM, recipient pays GST. This is also true. Yes, then GST is always paid by the government. No, this is false. The third point is TDS under GST. Okay. Let's say here is your government department. If government department enters into any transaction, let's say here is vendor, okay, here is supplier, here this time government is going to be buyer. So vendor, supplier here will transfer goods, correct, transfer goods, and government will make the payment, but this payment is going to be after deduction of GST amount. Yes, so this GST is known as TDS under GST. So last option, that is false, because every time government is not allowed to pay GST, and only when government is the buyer they are going to pay the GST amount. Chaliye, so which two options are correct here? 1 and 2. Right answer is answer B. Techniques used in analysis and presentation are linear programming, statistical quality control, charts relating to sales, earning, market share, investments, etc. Now these are covered under A. Financial statement analysis, B. Statistical and graphical techniques, C. Selecting appropriate method of reporting, or D. Financial planning. So basically, when we talk about cost accounting and management accounting, especially under management accounting, we are saying that management are responsible for decision making. Yes, managements are responsible for all your decision making. Yes, which step to be taken, which product to be manufactured, how you are going to manufacture, for everything. Now there are different tools through which they are taking this action. Yes, so there are different types of tools. Now one of the tool is defined here. So which particular tool is defined here? Remember, when we are talking about some techniques through which you can use some chart, some presentation, so basically that is related to statistical and graphical techniques. Under financial statement analysis, we are using balance sheet comparison. Yes, current with your previous year, current quarter with the previous quarter, that is what financial statement analysis. Now selecting appropriate method of reporting. Remember, each industry in India, they are working differently. Hana, you cannot say what banking business or banking industries are applying AS or whatever acts they are applying. Same you need to apply in cement industry. As per your business nature, you need to identify your own methods, yes, and then you need to apply it, and as per that you need to report it. That is what selecting appropriate method of reporting. Then financial planning, that in upcoming financial year, yes, how much expenditure we are going to plan, yes, what investments we can make, what are the different products we can manufacture. Basically you can say you are preparing for upcoming financial year budget. That is what financial planning. So as per your given question, they are asking about statistical and graphical techniques. Remember, suppose when you see management, Hana, now in that management you can see all are from different educational background, correct? Some are from science, some are from commerce, some are from arts. So now if let's say this mathematics background person prepares the report, so that person must be using trigonometry, है which is not very easy to understand. Of course, if here you see, let's say commerce student, that person is using lots and lots of, let's say, accounting terms, which is again difficult for each and every person standing here or present over there. So what you can do, you can easily prepare some charts. See, if I am showing like this, okay, it is assumed now that there is some growth we are talking about. Yes, if I prepare this type of pie chart, you can say that this proportion is the biggest proportion. Yes. So if you are not aware about anything, but based on these charts and based on these graphs, you can easily tell what we are talking about. Yes. So this is your first question. Chaliye. So here's the textbook part. You can read it afterwards. Okay. Chaliye. Next question. A manufacturing company has 100 units in progress. Now remember, always for equivalent units, we need to calculate here, all your WIP into their percentage of completion. When you multiply these two things, you can get equivalent units. So out of these 100 units, 40 units are at 60% completion. Okay. You need to add plus 30 units are at 50% completion, plus next 30 units are at 80% completion. Yes. So here you just need to multiply units with their respective completion. So acha, we need to add here. No? That's why I'm writing here. Okay. So what is the total answer here? Just solve it and tell me the final answer. 40 into 60%. 40 into 60%, 24. 30 into 50%, 15. 30 into 80%, 24. So your answer is 63. Yes. So equivalent units here is equal to 63. So right answer is none of the above. Correct? Chaliye. This is how you need to solve equivalent unit numerical. Very easy. Just remember this formula. WIP you need to identify and percentage work completed on that units. Chaliye. Now coming to next question. Okay. Now this one is statement based question. Okay, as you can see, lengthy options are there. So let's read it. Which of the following best summarizes the primary objectives of cost accounting in relation to prioritizing various products, cutting cost, and maximizing profits? A. To compare actual cost with the prevailing cost of standards or estimates for providing unnecessary wastages or losses of materials and other resources. B. To provide the necessary information to enable shareholders to make specific or long-term economic decisions. C. To record, analyze, and classify all incomes related to the cost of products and services. Or D. All the above. So what is the objective? What is the objective of cost accounting? Yes. Now what is the meaning of cost accounting? See, this cost accounting is generally applicable on businesses. Okay. Like how much expenditure they are doing. Yes, for manufacturing, what are the expenditure they are doing? Yes, if they are incurring any unnecessary expenditure, how they can eliminate those expenditure, that is also cost accounting will tell. Here you can record each and every cost. Hana? You can identify that what actually amount is utilized to manufacture any cost. Not only here, amount, but also which type of labors we have appointed, which type of materials we have used, in what quantities we have used. Yes, what are the wastages that we have generated during the process. You can generate each and everything. And yes, with the help of this particular thing, you can say that your investors or can also take the advantage. But directly, cost accounting is not used by investors. Yes, cost accounting is used by management. Yes, this is your internal document. This is your internal document. Yes, so right answer is answer A. To compare the actual cost with the prevailing cost standards or estimates for avoiding unnecessary wastages. Always remember, before you start any work, you are going to prepare, some sort of estimates. Yes, like before you started your JAIIB preparation, first you did all your analysis. Similarly, when you are doing any manufacturing, first you are going to do all your analysis. Then after that, you will actually implement those progress, that work. Then after standards, after planning, what you will be doing, you will be actually working on those projects. So what are the actual outcome? Then you will compare. Are you working as per planned steps, or there are any deviations. So if you find any deviations, you will take corrective actions. Or in between, if you find any losses, wastages which are unnecessary for your manufacturing, you will try to eliminate it. Okay, so right answer of this question is answer A. Chaliye. Next. Now this question is very easy. Abnormal loss arises due to dash. Now this question is homework question. A. Normal circumstances. B. Abnormal circumstances. C. Evaporation. D. Improper production process. So everyone, this is your homework question. Let's see whether you can solve this question or not. Okay. Acha. Before we proceed further, let me tell you. In your course, you have two types of losses. Okay, in costing, we have two types of losses. One is normal loss, and next one is abnormal loss. Yes, normal loss, this is inherent in nature. What is the meaning of inherent in nature? You cannot eliminate these expenses. Hana? You can use any step, but you cannot eliminate, you cannot remove this expenditure. For example, if you see petrol, what is the nature of petrol? If you use that petrol openly, hana, in a fresh air, it will get evaporated. So that is the nature, and because of that evaporation, whatever loss you will see in your petrol, that is going to be normal losses. Okay. Abnormal losses, this is, some abnormal conditions are there. Correct. So let's say there is a strike in your factory. That strike is only in your factory. Yes. Let's say there is a fraud in your bank. That fraud is only in your bank. So who will suffer? Only your bank. So because of some specific activities which your bank or your industry or your particular company is facing, that is abnormal loss. Not everyone is not facing that thing. Yes, so that is what abnormal loss. Chaliye. So here we discussed about normal and abnormal loss. And that question was your homework. Let's read next question. Now, it is costing of a specific order for production or rendering of services as per the requirements of the customer. Now, it involves recording all the costs incurred for completing a project so that it may be appropriately priced. Estimation of cost is difficult as very little data may be available due to uniqueness of the job. Now, the time required for completing the task is less than 1 year. So, above points gives the feature of what? Contract costing, process costing, batch costing, job costing. Okay. Now, when we talk about costing, basically we are calculating what are our total expenditures that we incurred during production. Okay. Now, in India, we can see there are different types of businesses. So, we cannot apply same method in each and every business. Like your banking industry cannot apply contract industry methods. Yes. Same thing if you see any FMCG company, they cannot apply banking laws and regulations. So they need to use some specific type of methods to calculate cost. So under this, we have costing methods topic. So costing methods tells you that if you are working in this specific company, you can use this particular method. Like contract costing. If you are in infrastructure project company, if you are constructing any society, especially if you are taking time for more than 1 year, then you are going to use contract costing. Process costing means like FMCG companies. Continuously manufacturing is going on. Batch costing means here you are producing goods in lots. Okay. Basically, you are producing goods in lots. That is what batch costing. Job costing means here you will be getting specific order. Yes, and your time limit is also less than 1 year. In your contract costing also, you get specific order. Yes, as per your customer demand, you are going to construct that building or that society. So let's read this 4 points again. It is a costing of specific order. Okay. Now they are not talking about continuous processing or batch. Okay, some specific order we are getting. Yes, so this is the first term which you need to remember. Okay, as per this you can say answer is either contract costing or job costing. Now it involves recording all the costs incurred for completing a project so that it may be appropriately priced. Okay, now this also happens mostly in both the cases. Estimation of cost is difficult as very little data is available due to uniqueness of the job. Okay, and the time required for completing the task is less than a year. Yes, this last point is going to help you to decide which is your right answer. Yes, A or D. As you can see, here time requirement is less than 1 year. So right answer is answer D. Otherwise, in contract costing, you need to give more than a year time period. Okay, so this is about your one more question. Next. In a manufacturing process, normal loss is inevitable and needs to be accounted for in the cost of production. Now consider a process where 1000 units of raw material are introduced with a normal loss of 12.5% anticipated. Now if the total cost incurred for the process is 50,000 and scrap value of the loss is negligible. So what would be the cost per unit? Just give me one moment. Yes. So what would be the cost per unit of the final output? Okay. So basically we need to calculate here cost per unit. Okay. So here what are the given details you have? You have input. Okay. That is 1000. This input means your raw material. 1000 units here. Then normal loss is given. That is equal to 12.5%. Yes, and total expenditure is equal to 50,000. Yes, now how to calculate cost? Yes, I told you in our paid class to calculate cost per unit. If nothing is given, use universal formula. If nothing is given, use which formula? Universal formula. And what is that universal formula? Total cost divided by units. Okay, this will give you cost per unit. This is your universal formula. So this you can calculate any cost. Now, here also you are going to take total cost, yes, divided by number of units. Yes, that is your input units. But remember one thing, here we have a normal loss also. So you need to subtract this normal loss. Yes, so total cost is equal to 50,000 divided by number of units, that is equal to 1000 minus 1000 into 12.5%. And this normal loss means you cannot eliminate this cost is inherent in nature. Yes, so this is what normal loss means. So what is the answer here? 50,000 divided by 1000 into 12.5%. So 125 minus 1000. So 875 units, 50,000 divided by 875, this will give you 57.14. Yes, so rupees per unit. Correct answer is answer C. Yes, this is how we need to calculate cost per unit. Okay, remember from this costing methods in your May 25, there are around 15 to 20 marks question. So remember this particular module D is very important. Yes, if you want to cover, or if you want to score maximum marks in your AFM, then this module D will help you. This module D is very easy compared to your remaining 3 modules. Yes, chaliye. Next, a production or service location, function, activity or item of equipment whose cost may be attributed to cost units. Now this is the definition given by A. Chartered Institute of Management Accountants, Indian Institute of Chartered Accountants, Institute of Management Accountants, the Association of Chartered Certificate Accountants. Yes, please tell me. So right answer here is, always remember, all the definitions in your costing is given by most of the time by Chartered Institute of Management Accountants. Yes, that is CIMA. Chaliye. Very easy, direct question. Next, The customer keeps some amount of money out of the progressive bill payments with himself dash. As a contract is spread over a long period of time, the contractor runs the risk of price to cover dash is prepared. Now remember, under contract costing, yes, under this contract costing, there is one term which is related to progress payment. So what is the meaning of progress payment? Generally under contract costing, you are getting specific job and life of that job is more than 1 year. Okay. So now progress payment means here your contractor will construct your building, and as soon as he constructs a building, you are liable to make the payment. As a customer, you need to make the payment. You will not wait till the end of the contract. Your contractor is making that building, you need to pay as per that. Okay, that is up to your agreement, monthly, quarterly, weekly, how you're going to make the payment. So he will construct, let's say, ground floor, you need to pay ground floor amount. He constructs first floor, you need to pay first floor amount. Second floor amount. So what is this? Progress payment. Okay. But here, sometimes, let's say this progress payment amount is equal to 1 lakh. Now we know if we pay all the amount, might be the possibility that contractor can stop the working. So for the safe side, generally what customers are doing, they are retaining some amount, they are keeping some amount. Let's say contractor has done total construction of rupees 1 lakh, but now we are not paying total 1 lakh, we are retaining 5,000 and we are paying only 95,000 as progress payments. So whatever amount we have kept, that is 5,000, that is your retention money, that is known as retention money. Okay. So the customer keeps some amount of money out of the progressive bill. Yes, 1 lakh total construction contractor has done. Now you are giving only 95,000 and keeping 5,000 with himself. So this is what? Retention money. Okay. So you can eliminate C and D. Now, as a contract is spread over a longer period of time, more than 1 year, and inflation is there. Yes, things are becoming costlier day by day. So let's say you started construction this year, but after 3 years, now the cost of material, labor will be higher than current price. So whatever the price will be increased during this time period, who will bear it? Who will bear these losses? Customer will bear it. And now contractors are very smart. So what they are doing, while making agreement, they are writing this under terms and conditions. That tomorrow, if any amount increases, okay, during the construction related to material, related to labors, customer is liable to pay for it. Customer will be paying that amount. Yes. So that is what? Escalation clause. So this is your escalation clause. Right answer is answer A. I hope everyone got this one. Yes. Chaliye. That is, which of the following best describes the function of the budget controller? Yes, this question is from the last unit and here are the options. Overseeing and controlling all departmental functions and issuing instructions. Then B option is about complying various types of information to prepare realistic budgets and proper reporting. C. Directing and managing the execution of budgetary plans. Or D. Implementing cost-cutting measures across all departments. So what is the role of budget controller? Yes, what this budget controller is actually doing. So budget controller is actually complying with all the types of information which is actually given by the top level management to their junior departments. Yes, what is our goal, vision, how we are going to achieve it, how we are going to establish our targets, everything is given through this controller. Yes, so controller is the person who is going to prepare more realistic budget, not just some random numbers, some random goals. No, he will ensure that all the goal of our organization should be achieved with the budget, and proper reporting should be done to respective senior management. So the right answer of this question is answer B. Yes, so all these functions are done by budget controller. Now Next, here you can read this theory part as well. Yes, this is from your IFBF book, so you can just read it. Chaliye. Coming to next one. Now, which of the following statements accurately reflects the difference between marginal costing and absorption costing? Option A. In marginal costing, both fixed and variable overhead costs are allocated to the product, whereas in absorption costing, only variable overhead costs are allocated to the product. Additionally, the profit, cost volume profit CVP relationship is used in absorption costing but not in marginal costing. B. The CVP relationship is crucial in marginal costing but is not typically used in absorption costing. C. In marginal costing, fixed overhead costs are allocated to the product along with variable costs, whereas in absorption costing, only variable costs are allocated. Furthermore, the CVP relationship is not used in either costing methods. D. In marginal costing, all overhead costs, both fixed and variable, are treated as period cost, whereas in absorption costing, both fixed and variable overhead costs are allocated to the product, and the CVP relationship is used to both costing methods. Now, this is one very lengthy question you can say, but if you know what is the difference between this absorption costing and marginal costing, then this question is very easy. See, in marginal costing, what we are saying whatever extra expenses that you are incurring. Yes, because of that only you are able to generate one more unit. Yes, for generating, for manufacturing one extra unit, you are incurring here all your direct expenses, all your variable cost. So basically, in marginal costing, we always consider variable cost and we, ignore fixed cost. Okay. Whereas in absorption costing, when we are talking about this type of costing, we are saying that whether you are incurring variable cost, whether you are incurring fixed cost, we are going to add each and every type of cost in your calculation. Yes, so major difference between these two type of costing is only fixed cost. In one method you are adding fixed cost, that is absorption. In marginal costing you are ignoring it. Okay. In marginal costing only you are calculating contribution. Yes, here you are calculating break even points. Okay, but in absorption costing we are never going to calculate any contribution break even points. So let's read the options once again. In marginal costing, both fixed and variable costs are allocated to the product. What do you think? In this first line only they are saying you will add fixed and variable cost in marginal costing. This is wrong. Hana? You will never add fixed cost while calculation of marginal costing. After calculation of contribution, you are going to adjust this fixed cost. Then next, first option is wrong. Then the CVP relationship is crucial in marginal costing but is not typically used in absorption costing. Huh. So what they are saying that CVP is crucial in marginal costing, of course, but is not typically used in absorption costing. Huh. This statement is correct. Okay, then next one is in marginal costing, fixed overhead costs are allocated to the product and along with variable cost, whereas absorption costing only variable cost. Again, they are saying wrong thing that in the marginal costing you are going to add fixed plus variable. Wrong. So C statement is also wrong. Okay. We are saying B1 is true, but let's read if you find any other accurate answer. Then last option is about in marginal costing, all overhead, whether variable fixed, are treated as period cost, whereas in absorption, fixed variable allocated to the product. CVP relationship in both the costing methods are used by CVP. This is totally wrong. CVP calculation is also done under marginal costing. So right answer of this question is answer B only. Okay? Chaliye. Coming to next question. Now let's solve a numerical. Okay. A company manufacturing smartphones has the following financial information. Total fixed cost 5 lakh, selling price per smartphone 25,000, variable cost per smartphone 10,000. Now, given that the company sells 100 smartphones per month, what is the break even level of sales of the company? What you need to calculate here? You need to calculate here break even level. Yes, this is your break even level calculation. Okay. So, what is the meaning of break even? Break even means no profit, no loss earned by the company. Okay. When companies are at break even point, they are not at all going to earn any profit. They are not at all going to earn any losses. Now remember one thing, when you are starting any business, Hana, when you are starting any business, just tell me, what do you think? Are you going to earn profit from day one only? Can you see that you have some loyal customers for your business? No. Hana, because you don't have any brand value, no goodwill, you just started this business, so, and no profit also. So for few initial years, you will see losses. Yes, after that, you will be at break even point where you are going to earn no profit, no losses. At least you can survive. And after this break even point, you will see profit. Okay, so they are talking about this level. See, if you're saying zero is your break even level, then you are wrong. Okay, then you are wrong, because businessmen, when they are manufacturing zero units, then also they need to incur some expenses now. If you're saying, let's say, 0 units as your answer, okay, but here you are not manufacturing, but you are incurring rent expenditure. Yes, okay, so here I am saying, if you say break even point is always equal to 0, then units is the answer. Then you are wrong. Why? Because at 0 units, though you are not going to incur any direct expenses, yes, like no raw material purchasing, no labors, but then also you need to pay for electricity expenditure, for insurance, yes, for rent. Some expenses are constant, whether you do the manufacturing or not, these expenses are required to be paid. So you can say you are paying expenses without generating any income, so you will be seeing loss in your company. Okay, this will be giving you loss. Okay, so that is the point you need to remember. So here, 0 unit is not your answer. We are going to produce some units, but that unit will not give you any profit or loss. So what is the formula of break even level? So formula is fixed cost, and always remember, fixed cost will be in your total divided by sales per unit minus variable cost per unit. And this variable cost means VC. This is your selling price. So we need to take per unit data. Yes, per unit data. And when you subtract sales minus variable cost, you get contribution. Yes, so in your denominator, you can write sales minus variable cost or contribution. Yes, so remember these formulas. Chaliye. Now, let's use your given data. So total fixed cost is equal to 5 lakhs divided by, okay, so per smartphone selling price is 25,000 minus 10,000 variable cost. So what is the answer here? 15. Okay, 5 lakh divided by 15,000. So per smartphone, you are going to see 33.33 units. Okay, so if you are dealing in 33 smartphones, you will be generating this break even level, means no profit, no loss. So this is your answer. Okay, so this is how we need to calculate break even level. Chaliye, coming to next question. Now, which of the following is not a category into which the standards are normally classified? Now, what are standards? See, here before manufacturing, yes, before starting your business, yeah, or before starting any new financial year, you are going to make a plan. Yes, here you are going to estimate about your expenses. Yes, so this estimation, this planning of your upcoming time period is given through standards. Okay, so in generally we are going to create standards for material, labor, or overheads. Okay, these are your other direct expenditure which are not covered under material and labor. Yes, so you need to create standards for these three elements. Now, there are different types of standards. Okay, first is like basic standard. Under basic standard, we are talking about long-term plan. Long-term plan. Yes, ideal standards, we are saying everything is going to be in our favor. Yes, this is your favorable standard. But in reality, you cannot say that everything will be in your favor. Yes, because there are different factors which affect our manufacturing, which affects different industries. Yes, like though your industry is performing very well, but as you are under a war, you are going to bear that losses. So you need to understand that risk is a part of your business. Okay. So this is your ideal standard, which says that we say that our business will be never under any risk. That is wrong. And from time to time, which you are updating, yes, which you are updating from time to time, you are updating material, labor, expenses, cost, and you are updating your budget, you are updating your estimates based on your scenarios, that is currently attainable standards. So these are the three classifications of your standard, but fixed standards is not your answer. So right answer is answer A. Yes, this is direct theoretical question. Next. Okay. A company that achieved sales of rupees 50 crore decides to increase its next year's budget by 10%, using 50 crores as a base. In contrast, which budgeting method requires starting from scratch and justifying each expense without relying on previous year's data? Okay, so first let me tell you what is budget. Yes, budget means your estimation. Yes, like every year on 1st February we get union budget. Yes, so that union budget is for upcoming year. So basically we are planning for our income sources. Yes, we are talking about our expenses. Yes or no? So this is your budget. This is your budget. Now, under budget you can see majorly three types of budget. Okay, first is like zero based budget. Means every year starting fresh. Yes, no previous data will be included here. Always you need to start fresh. That is what zero based budgeting. Yes, then performance budgeting. Performance budgeting means here when you are comparing your standard budget with the actual budget. Generally, this budget is used by government agencies. Okay, and one more budget is there, that is program budget. Yes, when you are creating budget for some specific activities or some specific program, that is a program budgeting. So here your right answer is not your A or C. You can say B or D as your right answer, but which exactly this paragraph is describing? We are saying that in contrast to first two lines, now we are starting from scratch every year. Every year you are going to start fresh, and you need to justify your reason why we are selecting this and not this. That is what given under zero based budgeting. So right answer is answer B. Yes, chali next. A company sells its product at 500 per unit. The variable cost is 325 per unit. Fixed cost amount to 3,50,000 per annum. Now based on this information, you need to tell me about PV ratio. What is PV ratio? PV ratio tells you relationship between contribution and sales. Yes, so formula of this PV ratio is equal to contribution divided by sales into 100. Yes, we are calculating ratio, so you are going to receive answer in percentage. Remember, PV ratio tells you the relationship between sales and contribution. How much means whatever quantity you are selling, whatever selling price you are earning, how much surplus you are generating, and how to get contribution. Contribution you can calculate by taking sales minus variable cost. Acha, this is not a profit. If you want to calculate profit, you need to take two things. That is your selling price minus your total cost. Okay. Now, here in your second formula, if you subtract fixed cost, you will be getting profit. Yes, because total cost includes variable cost plus fixed cost. Yes, what is our general formula for calculating profit? Your income minus expense. Expense will be including all your expenditure, whether variable, whether fixed. Achha, what are variable expenditures which are direct in nature, like your raw material expenditure, labor expenditure? Yes. What are fixed expenses? These are your, you know, constant type of expenditure. Whether you are doing manufacturing or not, you are going to incur it, like insurance. Hana? Whether you do your manufacturing or no, you are going to incur this insurance expense. Chaliye. So here sale is equal to 500, variable cost 325, fixed cost. Are you going to use your fixed cost? No, this is just one extra information. So contribution, okay, so contribution is equal to 500 minus 325. So 500 minus 325, this will give you 175. So 175 divided by selling price 500 into 100. So 175 divided by 500 into 100. So right answer is 35%. Yes, so here right answer is answer A. Okay everyone, remember from module D you have some important numericals like your contribution calculation is very important. Okay, break even calculation, then margin of safety calculation, yes, costing methods calculation, these are very important. Yes, then PV ratio calculation. Okay, so you need to remember these formulas, especially from module D. Chaliye. Next, who is responsible for the document setting out instructions and guidelines relating to the preparation and use of budgets? So like in every industry we have our some set of rules, some set of guidelines. So in under which document you can see this? Similarly, when you are preparing budget, you need to see this instructions, see this guidelines, that is given under budget manual. Okay, so right answer is answer B.